All right, welcome everyone to The Explainer. Today, we're diving into the Inland Revenue Authority of Singapore's 29-page e-tax guide on variable capital companies. Now, I know, reading through tax legislation isn't exactly everyone's idea of a thrilling afternoon, but hey, that is exactly why we're here. We're going to take this dense, highly technical document and translate it into a truly comprehensive visual guide. Basically, a clear, actionable blueprint built specifically for regional fund managers. So let's just jump right in, shall we? Okay, here's our structural roadmap for today. 1. The anatomy of a VCC. 2. Core income tax principles. 3. Navigating tax incentives. 4. Rules for redomiciled funds. And finally, 5. Stamp duty essentials.
Section 1. Anatomy of a VCC. Laying the foundation.
So, what exactly is a VCC? Well, introduced under the VCC Act of 2018, a variable capital company is a unique body corporate whose sole object is to operate as one or more collective investment schemes. And honestly, what makes this structure so incredibly attractive is the sheer flexibility it gives fund managers. You can set it up as a single standalone fund or, and this is where it really gets interesting, as an umbrella structure housing multiple, totally distinct sub-funds.
And this perfectly illustrates the core concept you've got to keep in mind throughout this whole explainer. Think of it, quite literally, like a giant umbrella. The overarching canopy, that's the umbrella VCC itself. This canopy is the actual legal entity that issues shares to investors and holds the tax residency. Then, right underneath that protective canopy, you have the sub-funds. These are the legally segregated investment schemes that hold your specific assets and liabilities. Pretty neat, right?
Section 2. Core Income Tax Principles. A Single Entity View.
Okay, so for income tax purposes, the tax authority essentially just zooms out. Meaning, no matter how many distinct sub-funds you're operating under that umbrella, the Inland Revenue Authority of Singapore looks at the entire overarching structure as just one single unified company under the Companies Act 1967. This is an absolutely crucial point to remember.
Because it's viewed as just one single entity, everything naturally flows from the top down. Tax residency? That's determined by where the control and management of the VCC's business is actually exercised, which is usually wherever your board of directors holds their meetings. So the residency of any sub-fund strictly follows the umbrella. And if you need a certificate of residence, a COR, to claim treaty benefits, it's issued strictly in the name of the umbrella VCC, and they just list the sub-fund's details inside it. Oh, and the best part? Since it's treated as a Singapore resident company, dividend distributions made to your shareholders enjoy the standard tax exemptions. You absolutely love to see it.
Section 3. Navigating Tax Incentives. Pillars of the Framework.
Now, because a VCC's sole purpose is to be an investment fund, it doesn't just automatically get every single corporate tax break under the sun, but it does get the ones that really matter to fund managers. VCCs can leverage some very specific safe harbor sections of the Income Tax Act. So whether you're running a venture company under Section 13G, a locally managed resident fund under 13O, or you're utilizing the 13U exemption, you can keep your investment returns highly efficient.
Let's take a look at how this single entity rule impacts general corporate exemptions, like the Startup Tax Exemption or SUT. Remember our golden rule from earlier. The VCC is treated as a single entity for income tax. That means when you're calculating exempt amounts and corporate tax rebates under SUT, they're computed entirely at the overarching VCC level, not down at the subfund level. The umbrella VCC then takes those benefits and allocates them across its subfunds in whatever manner it considers fair.
Now listen up, because here is a major watch-out moment for your blueprint. Because the SUT exemption only applies to the first 3 consecutive years of assessment, the clock starts ticking literally the exact moment the main umbrella VCC is incorporated. So if you decide to register a brand new sub-fund, say 2 years down the line, no way. It does not restart the SUT clock. Once it's ticking, it's ticking.
And here's another really strict restriction you need to keep on your radar. While the umbrella is treated as one company for income tax, the VCC Act itself actually demands strict segregation of assets and liabilities between subfunds to protect the investors. So, to maintain the integrity of that segregation, the tax guide explicitly states that you absolutely cannot transfer losses between subfunds using the standard group relief system under Section 37B. Basically, a loss in Subfund A stays locked in Subfund A. You can't use it to offset your gains in Subfund B. Make sense, right?
Section 4. Rules for Redomiciled Funds. Bringing funds onshore.
So what if you're already set up offshore? Well, Singapore actually allows you to transfer the registration of a comparable overseas fund directly into a VCC structure. But, and here's a truly fascinating exception to our golden rule, when you're redomiciling into Singapore, the tax framework applies certain modifications specifically at the subfund level. For instance, specific deductions like pre-registration expenses and impairment losses on financial assets are uniquely calculated for the specific subfund's historical overseas business rather than for the whole umbrella. It's a really important nuance.
Section 5, Stamp Duty Essentials, the exterior finishing.
All right, you're going to need to completely compartmentalize this next pivot to avoid some potentially costly mistakes. Under the income tax lens, as we've been talking about, the umbrella VCS is treated as one single company. But under the stamp duty lens, that whole umbrella analogy just drops away completely. For stamp duty purposes, every single subfund is legally treated as a completely separate, distinct person.
So why does this matter? Well, if Subfund A and Subfund B are treated as completely separate people, any transaction between them is going to be taxable. This means that if subfunds within the exact same umbrella transfer a movable property or shares between each other, standard stamp duties are going to be triggered. If a subfund acquires residential property, standard buyer's stamp duty and potentially additional buyer's stamp duty, depending on the entity's profile, absolutely apply.
A final stamp duty watch-out here relates to shares. Generally speaking, if a VCC simply cancels or issues shares, there's no share duty. However, if you try to get clever and use the cancellation of shares from one investor and the reissuance of new shares to a different investor as a sort of backdoor method to transfer ownership, yeah, the tax authority is going to see right through it. Under Section 33 of the Stamp Duties Act, this will be legally treated as a transfer of shares and share duty will be charged accordingly. So definitely don't try to outsmart the system there.
And there you have it. We've taken a pretty dense regulatory document and built a clear, comprehensive blueprint covering both the unified income tax approach and the totally segregated stamp duty realities of the VCC. Armed with this knowledge, I want to leave you with one big question to consider. Is your current regional fund strategy truly maximizing the incredible flexibility, the targeted tax exemptions, and the sheer efficiency of Singapore's VCC framework? It just might be time for a structural upgrade. Thanks so much for joining me on this explainer, and keep learning.